Good afternoon, ladies and gentlemen. This is Barry Norman on behalf of ETX Capital, and welcome to our Sunday afternoon webinar. I hope everybody's having an enjoyable weekend. Now that winter's here, we're getting moved into the holiday season. So let's get ready for our class on chart patterns and trend action. Now, for those of you that are joining us for the first time, ETX is a regulated provider, so therefore I'm required to give you a risk warning. So let me read that and get it out of the way. Trading in the financial markets may result in the loss of your deposited funds. Please ensure that you fully understand the risk or seek independent advice if necessary. ETX Capital provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which is provided in this webinar is for educational purposes only and is not intended to be a personal recommendation or construed as advice. So please keep that in mind. Very shortly, or towards the end of the webinar, we're going to be looking at some live charts, especially on Bitcoin, because it's the only thing that, one of the few assets that moves over the weekend. What we talk about is not a recommendation. I'm not even making an assumption where Bitcoin's going or coming from. I'm simply going to be showing you some patterns that were developed on the chart, having nothing to do with trading Bitcoin. Okay, so please understand, these are just examples. All traders must understand that there's a high element of randomness to the markets. Therefore, they will experience both winning and losing trades while following any particular trading strategy. Different traders following the same strategy will achieve different levels of performance. Past performance is not an indicator of future results. And one should always employ risk management. You'll find that understanding risk management, using it in every trade, and understanding order entry types is more strategic and more important than any strategy out there. Now, for those of you that don't know much about ETX, we are a fast-growing financial services company based in London. We are authorized and regulated by the FCA, the Financial Conduct Authority. And although we offer binary options on our platform, they are not yet regulated by the FCA. But since we're a regulated provider, all your funds are handled as under the regulator. And the regulators will be starting to cover binary options at the first of the year. So they will be a regulated product also. And our parent company, Monocore London, is a member firm of the London Stock Exchange. So you know you're trading with a big, successful, reliable company that is transparent at all times. So let's talk about trend patterns and interpretations. But before we do, because I know somebody will ask me in the middle of the class, so let's get it out of the way. This webinar is being recorded. If you'd like to see a recorded version of this class, in about 24 hours after the class, you'll be able to use the same link that you used to come to tonight's class to access the recorded version. Thank you very much, and let's get on with today's class. Now, technical analysis refers to the study of the financial markets based on price movement. It uses the assumption that price of a share or any asset reflects all the information about that asset, including market sentiment as well as perceived value. Now, too many newbies, novices, and even those experienced traders, the word you say technical analysis, all they think about are indicators and oscillators. RSI, stochastics, moving averages, Bollinger Bands. They jump right into that field, and that's what they think technical analysis is all about. But first of all, anything you do on a chart falls into the field of technical analysis. And the overall governing principle of any technical analysis is price action is the most important thing. Movement on charts and patterns we can see in these charts. The indicators or oscillators, such as RSI, stochastics, are secondary pieces of information. And remember that. Charting refers to technical analysis that is performed through careful inspection of an asset's price and data to form well-known patterns that emerge in prices. For example, head and shoulders, channels, triangles, wedges. Chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between the buyers and sellers of financial instruments in liquid markets. Pattern formations do not form a trading system, but rather provide an indication of future trend of a price of an asset as it breaks key psychological barriers in the form of support and resistance lines. There are many different types of patterns, and they're all named in accordance with the shape that you see on the price graph. These general categories are called triangles, channels, wedges, and head and shoulders. We also have pennants and flags. We have cups and tea saucers. We have tea and cup saucers, teacup saucers. We have all kinds of weird things that people have put out there. There's lots of ways that they see things in markets. Okay, we have W's and M's, but these are basically just double tops and double bottoms. So the most popular ones, the ones you should always recognize, are triangles, wedges, and head and shoulder. Okay. A triangle isn't very difficult. Okay. And it's to see in the price on the chart. And we'll go look at these in real live charts, but let's talk about how you define a triangle. We have symmetrical triangles, ascending triangles, and descending triangles. And they are exactly what the name says. A symmetrical triangle is just like a teepee turned on its side. A ascending triangle has the price moving upward. A descending triangle has the price moving downward. Okay. But they're all triangles. Okay. What we see when we see a triangle is that price is moving into a center of whatever this point is called, this narrowest point of a triangle, and it's building up pent-up demand. Now, a triangle is formed between converging support and resistance lines. A negative sloping resistance line indicates reduced level of profit taking and more uncertainty about the value of an asset. With a positive sloping support line, the price levels are squeezed into a corner. Once, hold on, I'll mark these on the chart for you. Once the support and resistance line is broken, the pressure that is built up as a result of the uncertainty is released, and a certain amount of momentum is added to the price change in the direction of the breakout. So if price breaks down, we can calculate the momentum that it should have to continue down. If price breaks up, we can calculate that momentum. And the width of the triangle also will help us determine entry and exit points, and we can also calculate the target point in each direction. So triangles can help you a great deal, but all chart patterns can be calculated. There are easy formulas for support and entry points, exit points, and how much momentum the asset should have when it breaks out. Okay. And that's important because that's very good for short-term trading. I've given you some handouts. I don't know how nicely they blow up on your screen, but you can very easily go into the internet and put these and just search for chart patterns and put in triangles or chart patterns, and you'll see these, because I didn't make these. I mean, I got them off the internet, and you'll see them. They're all standardized. They're not some unique thing that Barry's giving you that nobody else has. Okay. So you can find them fairly easily. There are specific variations of triangles that can occur, namely ascending and descending triangles. An ascending triangle has a horizontal resistance line, and a descending triangle has a horizontal support line. So ascending, support, descending, and they both have the horizontal. It's important you have a horizontal line, and in your ascending triangle or your up-moving triangle, you have your horizontal line here, which is your resistance line, and a descending triangle, you have it below, which is your support line, and then you need the opposite direction or an angular trend line underneath of it. In a regular triangle, both of these, and they're both, you could call them almost simply trend lines. But they don't follow the rules of trends. They simply use the swing highs and the swing lows to draw lines. So here we have the swing lows and we're drawing a support line. Here we have the highs and we can draw another line. So we have a horizontal line here and a moving up angle here. Here we have swing low, swing low, swing low. We've extended it forward, and we have our line between our swing high and our other swing high here, and it forms a descending line. So an ascending triangle usually occurs as a continuation of a bullish trend, while a descending triangle occurs as a continuation of a bearish trend. Makes sense, doesn't it? Now, how would you use a triangle to trade? It's important to note that an ascending triangle can also, at very rare times, be found in a downtrend. So the combination of the name of the triangle and the market trend is deceiving. Thus, the financial asset needs to test the resistance level twice, and the asset's closing price needs to be higher than the previous closing price. In other words, the closing price has to follow the rising trend line. Next, we come to volume, and volume is key. Now, as you know, volume is put on a price chart underneath the prices. Volume is the number of shares or contracts exchanged. When we are moving into a triangle, we need to look at volume because we expect volume to confirm the triangle. So when in an ascending triangle, volume usually contracts. Although there are a few number of cases that show volume has not contracted, but the pattern has been displayed. This has been signified by the blue line at the bottom of your charts. Now, it's important because if volume doesn't confirm the story that you're seeing in the triangle, then you need not pay attention to the triangle. Now, we can calculate the distance of the breakout momentum based on the difference between the support line and the trend line. So here we have the original triangle line, and we have the horizontal line, and we have the ascending support line. And so the distance between the rising trend line and the resistance line will give us our projection. So if our resistance level had been based at 1, and the start of our trend line had been valued at 0.5, then our projected value would be 1.5. So we would expect this momentum to move 1.5. Okay, if this was the, say, gold at 1250, and we had the start of the trend here at 1275, okay, we can then estimate that we expect gold to be the difference between the 1 and the 1250 or the 1275, or 25 points if it breaks out this way or if it breaks out that way. Okay, you have breakups and breakdowns, you have continuations and reversals. But when it breaks out of the triangle, it's going to have momentum. And by knowing what that momentum is expected to be, we can then get a trade in. Now, we'll talk about this a little bit more as we do the calculations towards the end. Now, we also have channels and rectangles. Now, to be honest with you, you don't have to remember all of these names. Okay, they're not hard names, but you don't have to remember the differences. Triangles, as long as you see a triangle in the chart, you can figure out whether it's ascending or descending or symmetrical. A rectangle is basically a double bottom, and a channel is a downward sloping triangle, but they're not moving together. So you have a channel. Basically exactly what the names are. A channel is formed between parallel support and resistance lines. Okay. Now we could call these trend line support and resistance, where we connected swing lows and swing highs. Okay. This pattern usually indicates a relatively strong trend, up or down, with the price staying between the lines until a breakout. A breakout from a channel indicates either a reversal in the trend or the change in the slope of the current trend. Okay. So similar to a triangle, a rectangle is formed between horizontal support and resistance lines. Again, these support and resistance lines are used by connecting swing lows and swing highs and projecting out support lines. So in other words, we found a swing low, projected it forward, found a second swing low, and projected it out. Found a swing high, found a second swing high, and projected it out. And we now have a channel. Okay. Not very difficult. You have up channels and down channels. In the previous we had rectangles, same thing. On the swing lows, the swing highs projected two lines from them similar to trend lines, and they were formed, both of them were horizontal, and they formed a rectangle. So now, rectangles and triangles are sometimes referred to as flags and pennants, depending on the slope of the initial trend and the slope of the breakout. A flag would be defined as a bullish continuation channel down, or a bearish continuation channel up. A pennant would be defined as a bullish continuation triangle, or a bearish continuation triangle. Okay. They all form these patterns. It's very simple. It's the price is moving up, or the price is moving down, or the two lines you drew sloping up or down. But then we go on to one more, which are wedges. But again, it's simply the definition of the slope of the support and resistance line. So if the slopes were equal, what would they be? They would be a channel. If the slopes were horizontal, what would they be? They'd be a rectangle. When the slopes are angling in towards each other, they would be a wedge. And a wedge is virtually an unfinished triangle. But a triangle has a horizontal support or resistance line. So in a triangle, one of the two lines is horizontal while one of the others moves at it. Or you have the asymmetrical or the symmetrical, which is they're both moving in towards the center at the same degree. So all we have are explanations for all the different lines we can put on the charts. Okay. And there's simply by drawing your lines of support and resistance connecting the swing lows and swing highs. If you can see something that looks like a channel, a channel, a box, or a triangle, you kind of know what they are. Okay. You know, whether you have a wedge continuation or a wedge reversal, what happens? In a wedge continuation, prices are moving up and the wedge breaks lower. In a wedge reversal, prices are moving down and the wedge breaks up. And it's all based on the slope of the wedge. But same is the slope of the triangle. The most common wedges are found as breakouts in the opposite direction of the wedge. That is, bearish breakouts in a rising wedge and bullish breakouts in a falling wedge. This is when they actually tell you something. So here we have, in the top example, we have what? Can somebody tell me what it is? It's a rising wedge. We would expect a breakout in the opposite direction. Now, when we get that breakout, if we could predict how far or how much that short-term momentum would carry it, we would be really smart, wouldn't we? We could definitely get a trade in if we knew that it would have enough momentum and where we could put it in. When we have a falling wedge, we're expecting a breakout upwards. And if we knew what that would be, we would be okay. Now, the most well-known of all these patterns is called a head and shoulders. A head and shoulders pattern describes a price momentum that depicts the head and shoulders of a person. Head and shoulders is a reversal pattern from a bullish trend to a bearish trend. But then we have the inverse head and shoulders, which is the opposite, and is exactly that. Now, the thing about a head and shoulders is you can't see it till it's almost formed. But once you see it, it's a pretty reliable signal. So what you see is, just imagine a person. It forms, price will move up and form a shoulder. But you don't know what your shoulder is. We don't have any other price move. But then it falls down and hits a support line and bounces back up and gets a new resistance line or a new top. and falls back down. And this is when you know you might be seeing a pattern, because it bounces down and hits that same support line and bounces off of it. So here we have the left shoulder, here we have the head, and now we have the beginnings of the formation of the right shoulder. At this point, if it bounces here to this level and starts moving down, we know we have a head and shoulders pattern. So what we're looking for are two fairly equal size. They don't have to be exact shoulders, because not all of us stand straight. We could be hunched over, we could be angular, but we form two shoulders, and then we have in the middle a head. Okay. Now that head, there are all types of interpretations. So don't misunderstand me here. There are people that say the head needs to be 25 points higher than the shoulder, or 14% higher. There's all kinds of things. We'll talk about them in a minute. But the head must be higher than the shoulder. But again, if we're talking about a person, they can have two left shoulders and a short neck and a big head. Or they can have a right and a left shoulder that are equally balanced and a long, beautiful neck with a long head. Okay. There's still a head and shoulders. The thing is, it's very easy to see it here on my chart, isn't it? But when it comes to the reality of trading, it's very difficult to see. But you have ample time to notice it as it forms in there. So the popular head and shoulders pattern is essentially a triple top pattern, except that instead of all peaks hitting the same resistance level, the head peak slightly higher, slightly higher than the shoulders. Some investors have specific beliefs about the amount of the bearish fallback that occur between tops, with some allowing 10% before the price returns to test the resistance level again. Some require at least 15%. Regardless of opposing views, these patterns are very popular among traders and analysts as they predict trend reversals with relative reliability. Signal strength is bolstered by an agreement from other indicators, such as waning volume as the trend nears exhaustion. Now, when we go to look in reality on a chart and want to see our head and shoulders, it's kind of difficult. It's buried in there. But if we were to draw a support line using swing lows and draw another support line using swing highs, what will we notice? The first thing we notice is the breakout above the resistance line, and that is forming the head. If we go back and look and see, we see the move up, the move down, the move up, the move down, the formation of the right shoulder, and then start moving down. Because all of this is, depending on what size chart you're using, what time frame you're using, could be a long period of time or a relatively short period of time. If you're using a 15-minute chart, it still takes a good deal of time to develop. So you don't have to rush. You can wait till that right shoulder forms and then see this back before. Because until that right shoulder forms and starts bouncing off of the resistance level here, believe me, you have lots of potentials that never form. And until it forms, it's not even worth spending the time looking at. But when it forms this right shoulder and starts to fall, we then have a confirmed breakout, and we can then trade that asset going down. But again, you have the time to find it because it takes a while. So let's talk about, once we can recognize these patterns, let's talk about a simple mathematical formula that will help us set our target points. Okay. And these target points can then be reversed to where we have to put our stop loss levels. Okay. Now, a head and shoulders indicates both the end of a trend and the possible change in the direction of an asset's price. The given pattern is formed in a trend representing 3 peaks. Okay. Though prices may be rebound to the neckline forming a resistance level, it is expected that the decline will continue. So we've now drawn on our chart, we got our formation of our left shoulder. We got the bounce down to the support line. which is we ultimately call the neckline. So remember, it's a human being. So it's left shoulder, bottom, that's your neck. It's up to the head, back down to the neckline, back up to form the right shoulder, and back down. So once we have that, we can start setting parameters. Okay. Number one, we have the high, which was equal to the move from the formation of the neck to the highest point that formed the head. Okay. This is a number. So if, say that we were looking at gold and hypothetically the neckline was formed at 1250, and the head came up at 1275, what is our formula? Formula is T is our target price is equal to N, which in this case is our neckline, which is what, 1250, minus the head, which is 1275, minus the neckline, which is at 1250. So we have 1275 minus 1250. What is that? That's 25. So we have 1250, the original neckline, minus 25. Or our target price would be 1225. So when it breaks this neckline moving down, when we get the sell signal, we would expect it to fall to at least 1225. That's not such a difficult formula, is it? But you find that it works. It could go down to 1215, 1210, but you have to have a price level to build your risk management theories on. You have to have a take profit level. Okay. Yeah, it could fall all the way down to 1200. There's no guarantee. But we need to know from the very beginning, do we want to enter this trade and how far will it go or what's our target? We also have easy formulas. Now, an inverse head and shoulder is the exact opposite. A regular head and shoulders develops during an uptrend, and a inverse head and shoulders develops during a downtrend. The formulas are just the exact opposite, okay? And therefore, they're pretty easy. So you just have to remember T is equal to neck plus, in this case, neck minus head. In a regular head and shoulders, it's T is equal to neck minus head. Now, a multiple top chart pattern occurs in an ongoing uptrend and indicates the trend is nearing exhaustion. If a security repeatedly has difficulty surpassing a certain price point, a multiple top pattern may form. What did you see when we saw a rectangle? It was a multiple top formation. As the bullish trend progresses, bulls repeatedly attempt to fail to push price beyond the resistance level, but are rebuffed by bearish pressure pushing the price back down towards its mid-range. Each time an attempt is made, the price breaks back to the point. So I don't put much reliability on double tops and double bottoms, only because they occur so often. Now, triple tops and triple bottoms, I believe in wholeheartedly, just like the head and shoulder banks. The rarer a pattern occurs, the more likely it's going to be correct. So double tops and double bottoms are reversal patterns that touch either the support or resistance line twice before reversing the trend. Look for a strong initial trend and a significant breakout in order to confirm a reversal. So again, they're fairly difficult to see unless you've been able to draw your support and resistance lines on using swing lows and swing highs. The calculation for your target point isn't that difficult. To calculate target, you take S minus H. So S is the support line. H is the height of the movement, and that will give you your target. The exact opposite occurs in a double bottom. So where T is the target level, R is the resistance level or the recent high, H is the pattern's height, the distance between the support and resistance level, you simply take T, the target price, equals R, the resistance level price, or which was the recent high, plus H, the amount that the price had moved between the subtract support and resistance level. Triple bottoms and triple tops are the exact same thing, but it happened one more time. The calculations are also the same, where T in a triple top is equal to S, which is the support level, minus the pattern's height, the distance between support and resistance level. Now, I gave you a handout that I think has some of this on there. They're not unique calculations. You can easily go on the internet and find these. Believe me, they're not hidden. These are standard things that all traders use. A triple bottom, again, is just the reverse. Now, once you can recognize these patterns, once you can do your calculations, okay, all that's not going to make you a good trade. It's not going to make you a smart trade. Okay, you have to use these over a long period of time and see them and be able to evaluate where they fall in your charts. You have to be able to evaluate a trend, okay? Because a trend is a well-defined price movement moving between pushes and thrusts. Remember, price doesn't move in a straight direction. Price pushes up, eases down, pushes up, eases back down. And it can move in a slow-moving trend or a strong trend. Okay? But an important measure of the quality of the pattern is that the trend that precedes it. It does not matter whether the trend is bullish or bearish, but the consistency and the duration of the initial trend partly determines the well-formedness of the pattern. You can get lots of patterns developing and very weak trends, erratic trends, congestion. Okay? You have to look at where these are developing. Now, you can have a very well-formed weak trend. You can have a very well-formed initial trend. You can have a very well-formed congestion. Again, where you can get good swing highs and good swing lows. But then you can have weak trends that have movement all over the place. They happen to be easing up, but they're just all this erratic movement. Okay, and so it's not a well-defined trend. So therefore, the reliability on the pattern you're looking at isn't that solid. So now the pattern is said to have broken out once it has crossed either the support or the resistance line. Okay. It is called a continuation. Okay. If the pattern broke out in the same direction as the preceding trend, so in other words, the price was moving up and it moved into a triangle and then broke upward out of that triangle, it is a continuation pattern. If it broke out downward, it would be called a reversal pattern. For example, a pattern described in a bullish reversal triangle would mean that it is a bullish signal. That is, the breakout was through the resistance line upward. Because it is a reversal pattern, that means the preceding trend was in the opposite direction of the breakout. That is, the preceding trend was bearish. So you have to look at what the trend is, and then you have to look at which direction it broke. So if it's an upward moving trend and it breaks out down, it's a downward moving trend and breaks out up. Okay? It can do either, because we're not guaranteed what is going to happen when it moves or breaks out. But we know when it breaks out, we know where we're expecting a breakout. When we get that breakout, we then know what we can then do with it. So I gave you this handout for sure. And again, if it's not easy to see, you can go to the internet, just type in, chart patterns, and you'll find it just like this. Okay, and this will help you determine where you want to put your target, where you'd want to put your entry point, and where you'd want to put your stop loss point, whether you're dealing with falling wedges, bullish rectangles, bullish pennants, rising wedges. Okay. As you can see, they're pretty standardized. And this is not just for me. Like I said, these are market standards. Okay. Now, Remember, a pattern. Oh, and by the way, somebody kept writing in here about teacups. To be honest with you, I'm not avoiding you. I kind of am avoiding you. Because first of all, it's one of the weird patterns that comes out. But to be honest with you, I don't know anything about them. I don't trade them. So I kind of can't tell you about them when I don't know them. So I'll be honest with you. I just don't know anything about a teacup pattern. And it's a very weird pattern. And like I said, there's lots of weird patterns out there. If I don't know about it, I can't. I would just be telling you the same thing you'd find in the internet. So I'm sorry about that. Now, a pattern is a series of data that repeats in a recognizable way. It can be identified in the history of an asset being evaluated or other assets with similar characteristics. Patterns often include the study of sale volume. And remember this. Not only do you want to look at the quality of the trend, you want to look, just say to yourself, I want to look at quality and quantity. Quantity is volume. So the quality of the trend and the quantity, or the volume, will give you a good understanding of whether you should rely on that pattern. Now, patterns can occur within a downward or upward trend or as marking the beginning of a new trend. There are bottoming, topping, and continuation patterns. There are a follow-through day patterns is used by some analysts to identify market bottoms. The head and shoulders topping patterns are popular among day and swing traders. Continuation patterns include cup with handle, flat base, 3 weeks tight. See, and I'm sorry, but all of these are just very unique. I'm not saying they're good, bad, or indifferent. I'm just saying I don't know enough about them to explain them to you. Now, a good addition or a good verification to chart patterns is using Fibonacci retracements, and they can be very easily added into your trend trading strategy. So you want to observe the retracements taking place within a trend and try to make low risk entries in the direction of the initial trend using Fibonacci levels. Simply put, traders use this strategy to anticipate that price has a high probability of bouncing from the Fibonacci levels back in the direction of the trend. So now we have a whole class on Fibonacci retracements and reversals, and you should come to that class because you can combine these together to see whether you have a simple retracement or you're actually having a reversal taking place. Now, okay. So, technical analysts and traders use the terms continuation pattern to describe seemingly random price movements that can be interpreted to mean a current larger trend is likely to continue. There are both bullish and bearish continuation patterns. Any given pattern is not considered complete until the price is broken out. Also, despite their widespread appearances, continuation patterns are still somewhat subjective. To combat possible false signals, traders use other technical indicators and even fundamental analysis to confirm the formation of a continuation pattern. Okay, so let me bring you up some live charts. And let's see, and I've got some set up here. Now, like I said, we're going to be looking at 2 charts on the up-to-the-minute Bitcoin prices. Please do not take this as a scenario to trade Bitcoin. It is not my indication or my recommendation to you. I'm not making any recommendations at all. Okay, and you'll see that the patterns we're looking at already have concluded. Well, actually, one hasn't. Okay. Now, here we're looking at Bitcoin Cash against the dollar. Okay. You can see here earlier in the price pattern, what do we have? We connected to swing lows and got a virtually horizontal line and the swing highs and got a downward sloping line to form a triangle that's somewhere between a descending triangle and a symmetrical triangle. Okay. We saw price move into the pent-up demand in the center of the triangle. Right here. And what did we get? We got a breakout, a bullish breakout in the direction of the trend. And if we would have measured this momentum here, we could have estimated that price to move that direction, and we could have gotten in a trade for going from the breakout here at 1210, moving all the way up to 1559. Now it moved a little bit farther, but look, as it formed a new triangle, look where that price is. It's equal distance just about to where we had said that initial formation would have been. Okay, now we see another triangle forming. We don't have any confirmation, but we have the upward sloping line and the horizontal line, and we don't know if it'll bounce back in, but if it moves here to the center, we could expect a bounce up to this level. Okay. But this is how we see patterns in charts. They're not impossible, they're here. And you can recognize the nice thing about channels is they form slowly. Okay. And therefore you have ample time to see them develop and be prepared for them. Here we have Bitcoin US dollar. And here we have the use of Fibonacci levels and Elliott wave cycles, which is also chart patterns. And we can see price in a well-formed triangle, in a well-formed trend, and we see a beautiful channel developing. Now we see price bouncing off the channel. We've also got Elliott waves here and everything else. And we have many other things. We see volume at the very, very low point. We're expecting if the price moves back down into this channel that it could break out going down, and any one of these, depending on where the breakout occurs, could be our targets. Okay. But this is how we would use these. And you can see here we've got a combination of other indicators where we have a divergence in RSI, where we see RSI moving in a downslope while our price channel is moving in an upslope. And we see volume at a very, very low point. We want to see volume move up. We got our Fibonacci levels on here, but we don't know where price is going to do at this point. And we're now in a wait-see pattern, see if it's going to break out upward, or will it break down as we are hoping, and then we can get to see where it levels and where it breaks out, and we can do our calculations from that point. So these are just some of the ways that you can see patterns on here. Patterns are ultimately important. Price patterns and trend action is more important than any other indicator on your charts. Support and resistance trend lines, trend patterns, and price patterns, because it's real price action. The indicators and oscillators are used to confirm. Okay, these will give you trades that will tell you where to enter. There's oscillators and indicators won't tell you where your target point should be, how much you expect to move. It won't tell you what your momentum will be. All of your chart patterns should be the first thing that you learn and master. So take those charts I hand out. There's only a half dozen of them or a dozen of them, so master them, get used to seeing them, and you'll be surprised how easily you'll find them in your charts, because they do occur quite often. I think I have one more chart to show you. So let me get all these markings off of here, and then we're going to say goodnight. Okay, here's a US dollar, Euro US dollar. And this uses some reverse triangles along with Elliott wave patterns. And we can see in here a very well-formed, or what a well-formed trend should look like. Push and ease, push and ease, push and ease, push and ease, push and ease. And now we're moving into an uptrend, push, ease, push, ease. So we're hoping that leg 3 will come up to this level, 4 will come down, and that would give you a well-deformed trend. This is also using Elliott waves, and this is the formation of the 5th leg. But we also have a very, very nicely formed trend line in here. As you can see, it looks really nice on on pictures that I show you, but actually seeing them in charts is quite difficult. And it's something you need to master, and you only master this by looking at your charts and trying to do these regularly. Once you do, you'll be able to look at these charts and see things in them right away. But it's a matter of practice, familiarity. And as in that note, I'll say goodbye to you all. Thank you very much for joining us. We're going into the holiday season, so we have a couple webinars this month, a couple interesting ones in December. And then starting in January, we have 14 new classes coming for you, completely new classes, and a whole new curriculum taking through January, February, and March. So we'll see you then. Now we're going to spend a lot more of those classes actually on the ETX platform, on the Traders Pro, using the charts right on the platform and using the platform. So we have a new class on mastering the platform, and we'll be working right on the charts on the Trader Pro platform starting in January. So that should help you get a leg up on doing all this right on the ETX platform. So thank you very much for joining us, and we'll talk to you again on Wednesday. Have a good weekend now.